I'm Andrew Moran, Liberty Nation's economics editor.
Very, very rocky.
Death by government.
Drain the swamp.
Hello and welcome to another installment of the Liberty Nation's Swamponomics videocast. I'm Andrew Moran, Liberty Nation's economics editor. This week, will the Federal Reserve take the elevator or the stairs? Since the Federal Reserve slashed interest rates for the first time in more than 4 years, the financial markets, economists, and policymakers have been trying to gauge the central bank's path in the coming year. Essentially, the conversation has boiled down to, will the Fed aggressively cut interest rates to ensure the labor market remains intact, or will the Eccles Building trim the benchmark federal funds rate gradually over the next 12 months to prevent a resuscitation of inflation pressures? Indeed, there is a divergence between the two tales. According to the CME FedWatch tool, the futures market is penciling in another supersized 50 basis point rate cut at the November policy meeting and further jumbo rate cuts in the year ahead. However, the US Treasury market has carved out a different path, anticipating that the rate-setting Federal Open Market Committee will nibble around the edges to prevent a repeat of the 1980s when inflation kept returning. The benchmark 10-year yield has risen as much as 50 basis points since the Fed announced a rate cut, resulting in higher mortgage rates and higher borrowing costs. And then there are the smartest men and women at the Federal Reserve System warning caution on the way down to lower interest rates. Appearing at the National Association for Business Economics in September, Fed Chair Jerome Powell admitted that he and his colleagues would not be aggressive. He said, quote, "This is not a committee that feels like it's in a hurry to cut rates quickly."
If the economy performs as expected, then that would mean 2 more cuts this year, a total of 50 more.
Many of his co-workers agree. Fed Governor Christopher Waller expressed skepticism of big rate cuts. The Fed's Susan Collins says there are risks on both sides, meaning there are threats to reignite inflation and threats to harming the broader economy. Fed's Alberto Musalem says going slow makes sense. And then, of course, minutes from the September Fed policy meeting reveal that several meeting participants championed a quarter-point rate cut to send a clear message of stability. The latest inflation data might be a cause of concern for officials. While they have essentially confirmed that the maximum employment side of the institution's dual mandate is their main focus, some of the numbers could spook officials in November. Headline inflation was higher than expected, and core inflation, which excludes the volatile energy and food components, rose to 3.3%. Additionally, core producer prices jumped to 2.8%, higher than the consensus estimate. So, charting a clear path for the Fed might be a challenge. On the one hand, inflation continues to be sticky and stubborn and shows an eerie pattern from the 70s and 80s. On the other hand, the job market keeps showing cracks before they're quickly pasted over with glue and gum. But doesn't matter anymore. For stocks, investors are apparently pleased that rates are coming down no matter what, no matter how quick, and no matter the size. Bonds, it seems, anticipate higher rates for longer, hence the 4% 10-year Treasury yield. Maybe the mantra on the way down to a low-rate environment is just index and T-bill and chill. That's it from this week. Please read my full Swamponomics column on the pages of LibertyNation.com, and be sure to check out my previous Swamponomics TV videos and interviews. Liberty Nation does not endorse candidates or campaigns or legislation, and this presentation is no endorsement. Thank you. I'm Andrew Moran, Liberty Nation's economics editor.
Very, very rocky.
Death by government.